At the beginning of the year, many investors feared rising rates, as it happened in 1994. But this is not our base scenario. In fact, it seems that we are moving one step further in the process of the crisis. We are moving from a sovereign crisis to a war of central bank. And once again, the debt burden has been transferred from one area to another. The best illustration for this is what is happening in Japan, as the Bank of Japan is the only buyer of the sovereign debt now. This is very important as it changed the equilibrium of the cash flow around the world. Recently, we have seen that the European and the American bond market have received a huge amount of cash inflow coming from the Japanese investors who are looking for higher yield. And I remind you that this is exactly what happened with the emerging market when the ECB and the Fed started their quantitative easing. And this is why we think that whatever will be the economic fundamental for the coming quarters, the bond market will be significantly supported by those cash flow coming from Japan. That's why we strongly believe that we will remain in a low-yield environment for the next quarters. In this context of low environment, we would like to share with you a strategy called rolling down the curve. Rolling down the curve is a strategy that optimizes the total return of a bond portfolio in a low-yield environment. We like this strategy because it's easy to implement and it can be implemented in any long-only portfolio. This strategy only relies on long-term, high-quality bonds. And we started this strategy in summer last year when all the bond market was mainly focused on credit. But actually, this strategy performed well as we did 8% of total return, while in the same time, the BBB corporate index in euro performed 6%. So if you would like to know more about this rolling down the curve strategy, we invite you to read our investment case called the Japanese Scenario, which is available on our website.